Good morning. The truth about value add in 2026. And value add used to be a simple concept: buy under market value, renovate it, raise the rents, and refinance. Into 2026, that strategy still works, but only if you understand a critical shift. Execution risk now outweighs acquisition prices. So, why traditional value add is breaking? And over the last decade, investors have made money buying underperforming assets and then renovating the units or improving the operations by getting rid of expenses, but also increasing rents, and then being able to refinance at lower cap rates down the road. Well, that playbook relied on cheap debt and also rising rents, but also cap rates compressing at the same time. So today, all three of those have changed. So what's different in 2026? And interest rates remain elevated, but they're on the path downwards. Rent growth has normalized, and cap rates are expanding rather than contracting. So insurance, taxes, and operating costs are also on the rise too. So we have to navigate a storm a little bit. But the result is the margin for error is gone. So the new value add equation is, in today's market, value add success comes down to one thing: can your improvements create real NOI growth and not just projected rent increases? So some smart investors might think to focus on expense reduction and not just rent growth. I think that's a smart play, but also operational efficiencies and automation if available. But tenant quality upgrades are important, as well as the long-term durability of the income from the property. So the key insight there is that the pro forma is no longer enough, and lenders and buyers want more proven performance. So where investors have got burned. So we're seeing deals fail for three reasons, really. One is overestimating rent growth. And many deals can assume aggressive rent increases, but also maybe they're underestimating the lease up timelines. And in reality, tenants are a little bit more price sensitive in 2026 is kind of what I'm saying here. But two is underestimating expenses. So biggest surprises there are property taxes, especially in Texas. We have a little bit higher property tax set up here, but also insurance premiums, especially if you're in a Gulf Coast market. And maintenance labor costs have also increased along this period. So any little bit more in expenses can wipe out projected NOI gains. This is the point. Three is mispricing your debt risk. And short-term bridge loans worked really well when rates were falling and refinancing was easy. But now refinancing risk is a real concept, and debt costs can kill your exit or at least reduce your profitability. So what actually works in 2026? Well, let's look at operational value add. So focusing on improving management, reducing inefficiencies, but also stabilizing your tenant base. Or two, basis driven buying. So deals only work if you buy below what your actual replacement cost is. So if you have the margin of safety built into that, you're going to set yourself up for success. And three is long-term financing strategies. So winning investors lock in longer-term debt, but also structure conservative exits. And then they don't have to rely on future rate drops to make the deal make sense for them. So location still wins. And in markets like Katy, Fulshear, and West Houston, demand is driven by population growth and business expansion and infrastructure investment in the area. And these fundamentals still support value add if executed correctly, is the point. So think like a lender and not just an investor. And here's the shift that most investors miss. Lenders are now gatekeepers of value add success. And what they care about, and what we all should care about, is looking at the projected debt yield from the project, but also the stability of the DSCR, and make sure the projections are actually realistic based on market data. And if your deal doesn't work for a lender, it's probably just not going to work, period. So the final takeaway is that value add isn't dead, but the easy version of it is. Keep it simple. And 2026 belongs to disciplined investors who are going to underwrite conservatively and execute operationally, but also structure deals intelligently. So call to action here is, if you're looking to acquire a value add property or structure financing the right way, or just avoid costly underwriting mistakes. Let's talk strategy. My name is Bill Rapp. Please visit my website, houstonrealestatebrokerage.com. Love to talk to you more. Have a good day.